Okay, dear students, welcome to the revision day, the first class. My name is Mustafa Mirchawala from Mirchawala's Hub of Accountancy, and I'm your SBR trainer. And first of all, before we move on, let's discuss the objective of this class. I have already conducted many webinars, many revision days, lot of past papers. Even I have posted it on YouTube as well. So already there are a lot of material available, almost from 2018 to 2021 or till December 2021, majority past papers I have recorded. So the objective of this session is not to teach. The objective is just the motivation, because now, as this is the last month, many students, they do message that, sir, we are not feeling confident and it's difficult. So it's natural thing, because it's a practical paper, strategic level, it's the last paper of financial reporting. So definitely they give you new questions. Each and every question is different from the previous one. And I've told you many times in my class that always go for your suggested solution, right? Okay. And for your motivation, you can see on the screen just the last attempt, some of the high scores, some of the high scores I have shared. I couldn't gather data from all students, but these are for your motivation. They were also like you. They studied the way you guys are studying. They availed the marking facility. You guys better know what is the marking facility. You should send your scripts. And as this is the last month, so you should send it frequently now. Okay. I'll also arrange the mock paper very soon. And then you guys will have a time limit to solve that mock exam. And then you can send me for marking that as well. So now, no need to waste more time. We are moving towards the very latest past paper, which just came on the net, and that is March-June 2022 attempt. Okay, so today we are going to discuss this question number 1 as well as one current issue. There are some latest current issues. Even if you have seen that document with the name of changes in the SBR course, although there is a minute change, but examiner has given one new current issue topic, which we'll discuss today, right? Okay, now, so this is the question number 1. It's also available on your exam software, but I have copied it here. Okay, you can see it here. After the class, you can get these slides. Whatever is written on the screen, you will get it after the class. Okay, so no need to write anything. Just concentrate on the class. Listen each and everything carefully. I'll try to go slow. No need to rush. Okay. One more thing, for your improvement, we are going to make a WhatsApp group, and it's my routine. We make WhatsApp group in the last month. So our admin has shared the link of WhatsApp group in the chat box. You can see. Wait, yes. This is the chat box. In the chat box, you can see the link of WhatsApp group. All of you, please join this WhatsApp group so that you guys can help each other as well. Plus, I'll also give you some data on that, and plus the next class update and the slides, everything will come in this, right? Okay. So my dear students, you all are requested to join this WhatsApp group, and you can even copy and paste it in the same chat box so that the new guys can also see, right? Thank you. Now this question number 1, this is not so much advanced. If you see this is very routine. I'm sure you guys have done by now. You have done consolidation, and in consolidation there is a case in disposal as well as in step acquisition. In disposal topic as well as in step acquisition, sub to sub. For example, you have 60%. You already own 60% shares, and now you're going to buy 20% more shares. So it's from 60 to 80 is sub to sub, right? You already had control and you still have control. Similarly, you had 80% shares and you disposed of 20% shares. So now you are coming from 80 to 60. So this sub to sub case is in this sub to sub case is in step acquisition as well as in disposal accounting. Okay, so they will test this area in very simple way, very simple cash marks. And in our routine classes we give enough time for this topic. Okay, now the next thing, let's start with the first paragraph. Luna Company is the parent company of a group that operates in the pharmaceutical industry. All entities in the group have financial year end 31st March, financial year end of 31st March, right? Now, the current year is 31st March X6. So don't forget the routine accounting period is 1st April to 31st March. And right now we are staying in 1st April X5 to 31st March X6 accounting period. Now, next. The following exhibits available on the left-hand side of the screen provide information relevant to the question. Number one, first we'll discuss this part and I'll solve it for you. I'll fix it for you immediately, right? Sale of shares in Starlight Company provides information regarding a disposal of shares by Luna Company in Starlight Company. That means we are Luna Company, we are parent company, we are Luna Company, we are parent company. Listen, and we already had so many subsidiaries, and now we are going to sell some of the shares. Now we are going to sell some of the shares of this Starlight Company. Okay, now read the history. Luna Company acquired its 80% equity interest in Starlight Company on 1st April X2 around 4 years back. Around 4 years back. Is everything perfect? My screen, my voice, everything is perfect? Please tell me. Okay, thank you. Now, so we bought the shares, we acquired this subsidiary almost 4 years back. That is on 1st April X2. Do remember this date. Okay, now Starlight Company had an issue 1 million equity shares and has not issued any shares for many years. Okay, that means originally this subsidiary issued 1 million shares and we acquired 80%. That means we had 800,000. We had 800,000 shares. We had 800,000 shares, right? Okay. Now, and no change in holding since many years. So we have 80%. Goodwill on acquisition was correctly calculated as 320,000, but had subsequently been impaired by 15% in 2004. Okay, come on, all of you be active. Originally at the time of takeover, the goodwill was 320,000 and this was impaired by 15%. Can anybody tell me what is the 15% of 320,000? Can anybody tell me what is the 15%? Yes, 48,000. So dear student, be very active. 320,000. 320,000 less 48,000 is the impairment. So how much goodwill is left now? How much goodwill is left now? It's 272. Okay. So now after all these things, after many years, how much goodwill is left? 272K. 272K goodwill is left. Okay, don't forget. Now, Luna Company values the non-controlling interest at fair value. That's very good. That means a full goodwill method. The fair value of the net assets of Starlight Company at acquisition exceeded their carrying amount by 200,000. See, what does it mean? The fair value of the net asset of Starlight Company at acquisition exceeded their carrying. This is upward fair value adjustment. It means upward fair value adjustment. That means at the date of takeover, there was some upward fair value adjustment. And the good news, see the good news. This all related to non-depreciable land, which is still owned by Starlight Company at 31st March X6. Okay, that means no issue of excess depreciation. This is pure. This fair value adjustment related to pure land. Okay, 200,000, 200K. Now, the remaining story. On 1st January X6, on 1st of January X6, read this date. On 1st January X6, that means 9 months after the starting of our recent accounting period. 9 months after the starting of our recent accounting period. I hope you remember the recent accounting period. Luna company sold only 100,000 equity shares in Starlight company for $7 a share. See, we already had 800,000 shares. We already had 800,000 shares and we just sold 100,000 shares. So originally we were holding 80% shares, and now after this disposal our holding is 70%. Our holding is 70%. So that means it's a sub to sub. Previously this was our subsidiary and now again this company is our subsidiary. So no change in control. No change in control. If you have taken, my dear student, be active. If you have taken the normal classes, you know, I used to write these words: sub to sub, no change in control, no change in control. And this transaction is between equity owners, no change in status. This transaction is between equity owners. So that's why in the consolidated books, we are not going to book any gain or loss in P&L. In consolidated books, we are not going to book any gain or loss in P&L, right? This is a routine case. Now, what's next? The only reserve now, the only reserve within equity in the individual, see, individual, this is very important line. Statement of financial position of Starlight company is retained earning. Okay. The balance of this reserve on 1st April X5 was 4658000. So all of you just keep quiet and think over it. This retained earning is from individual books. This retained earning is from individual books of S company. And also it is on the beginning of the year. Also it is on the beginning of the year. So you know, whenever you do the disposal transaction, you need net assets of subsidiary at disposal date. Whenever you do any disposal transaction, you need net assets of that subsidiary at disposal date. So my dear student, disposal date is 1st January X6. Disposal date is 1st January X6. Be careful. But they have given you retained earning of 1st April X5, and that is also from individual books. Individual. So if you know, in the individual books net assets, fair value adjustment has not already been added. Fair value adjustment is not included in the individual books. Yes, fair value adjustment is included in the consolidated books. So you know, in this 4658000, in this 4658000, you need to adjust the fair value adjustment if you want to calculate the real fair value of net assets, the real fair value of net assets of S company. One more issue, think over it. This retained earning is at 1st April X5. This retained earning is at 1st of April X5. And what's your disposal date? Active students, tell me, what's your disposal date? It's 1st January X6. So there is a 9 months gap. There is a 9 months gap. There is a 9 months gap. Okay. So you need to adjust. You need to adjust the profit 9 upon 12. You need to add 9 months profit in this opening retained earning. Okay. So what is the profit for the year? See the next line. Starlight company generated a profit for the year ended 31st March X6 of 165,056, which accrued evenly throughout the year. Okay. So this was the first thing, and this is routine transaction. SBR difficult level is something different. You will see soon. SBR difficult level is something different. This is routine transaction. You do such questions in your class. When you practice consolidation with your teacher, you do such questions or a bit difficult question than this in your class. So this is simple question, ready question. Now, giving you 1 minute, just read it, and then I'll move to the requirement. Okay. Now, before I move on to the requirement, I will just give you a layman approach, just a simple teaching idea of this requirement. See this. This is my routine to make such sketches in my routine classes. See, this is 1st of April X2. This is 1st of April X2. On this date, we did takeover. This is the takeover date. Okay. And then this is the first year. This is the second year. This is the third year. And this is the fourth year. And this is your this is your disposal date. Disposal date. Okay. Disposal date means you sold 10%, just 10% shares on this date. Okay. So now you need the net assets. You need the net assets of S company on this date. You need the net assets of S company on this date. So how you're going to calculate it? Just giving you an idea. No formal workings. First of all, what is in the net assets packet? The first thing is share capital. In the net assets packet, the first thing is share capital. So ordinary share capital is 1 million. We all know. You have retained earning, opening retained earning. That means this date. See, this date retained earning is 4568000. What you will do? You will add these. See. You will add these 9 months profit. Okay. So you will get some sort of updated net assets at 1st January X6. But now one more thing, this retained earning we have picked from individual SOFP of S company. So in the individual SOFP, fair value adjustment and goodwill has never been adjusted. So you will add the fair value adjustment as well, 200K, and the goodwill after impairment, because yes, in last 3 years, 9 months, there is some impairment as well. You guys calculated for me. So after impairment, there was some goodwill amounts. 272K. In this way, you will calculate your net assets. In this way is just informal working. In this way, you will calculate the fair value of net assets of S company at disposal date. And now use your brain. Previously we had 80% shares. So when we had 80%, so NCI had 20. And now we sold 10% shares. So we are at 70 now. So NCI will be at 30%. So we need to calculate increase in NCI. Very good. We need to calculate increase in NCI. Students, right? And I tell you a short technique. Even in my routine classes, I also discuss this technique. Listen, whenever you need to calculate increase or decrease in NCI, whenever you need to calculate increase or decrease in NCI, ask one question from yourself. Who is seller? Who is seller? Just ask one question from who is seller. And in this case, as this is the case of disposal, so the seller is P company. So now you need to calculate everything from parent company's point of view. And now just think, parent company was holding complete S company. Parent company was holding complete S company. So you need to calculate everything of S company. Everything which we just did. See the screen? And then you need to multiply it by 10% because you sold 10% of your company. Because you just sold 10% of your company. Okay. In this way, you will be calculating increase in NCI. So I repeat, whenever you need to calculate increase or decrease in NCI, just one question ask yourself. Who is seller? And in this question, seller is P company. In this question, my dear students, seller is P company. Okay. Now, one thing I would like to just tell you, that if you want to take the pick of question, you can take. So, okay, because I'll move the screen. If you want to take the pick of this question, you can, because it feels good when you have a question with you. It feels good when you can see the question. Okay, now let me show you the requirement. See this. This is the requirement. 7 marks, scoring 7 marks, scoring 7 marks. Like you can score 5.5 or 6 from this 7 very easily. Explain with calculations. Explain with calculation how the disposal of shares in Starlight Company should be accounted for in the consolidated financial statement of the Luna Group for the year ended 31st of March X6. Okay, so you just, no need to discuss about individual books. It's purely related to the consolidated books. Okay, there is a difference of accounting between individual books and consolidated books. So right now they are asking you for consolidated books. They are asking you for consolidated books. Okay, right? Let me show you some discussion, because in order to save time, because I just want you to make things understand. Teaching you how to type, it's not the objective. It's not, even I have done that in some classes. I have done typing in some classes, but right now it's not the objective. The objective is to making you understand what is the issue. Now, in the writing technique, I have guided you many times to try to write with heading sentence, heading sentence, heading sentence. Try to write in such a way that it will be easier for marker to mark. Don't make things difficult for marker. Okay, make things easy, simple, in points, in heading sentence, head easily. Now listen. First of all, I have written disposal of shares. How many shares you sold? Disposal of 100,000 shares, and this will make you from 80 to 70. However, this would still allow the parent to retain. Yes, we had the control and still we have control. Very simple lines, don't need to waste time on it. Very simple. Now, next thing, treatment number 1. Income and expenses should be consolidated for the entire year. Yes, for the whole year, like first 9 months and last 3 months, same control we have. So in the income statement, we'll simply do adding together as it is. There would be no impact on consolidation of the subsidiary assets, liabilities along with goodwill. Yes, even as at the year end, we still have the control, and when we still have the control, we'll do normal adding together in SOFP as well, right? The transaction will be treated as equity transaction because it does not result in loss of control. I told you. This is the case of sub to sub. This is the case of sub to sub. Already told you. So we had the control, still we have the control. Now, see this. Carrying amount, this appendix 1 we are going to calculate. We are carrying amount of non-controlling interest and NCI should be adjusted to reflect the changes in accordance with relevant interests in Starlight. Yes, we have to make the entry as well. I'll show you the entry as well. Luna should record any difference between the NCI, which NCI is adjusted, and fair value of consideration in the equity. Yes, the gain or loss. This is what we call gain or loss. The gain or loss should not be booked in P&L. The gain or loss should be booked within equity. This is gain or loss. This is gain or loss, and this should be booked. This should be booked within equity. This should be booked within equity, right? Now, as they have given you the numbers, it's better I show you the numbers working first, and then we move on. Okay. Now see and help me please with the numbers. Okay, what is the ordinary share capital? What is the ordinary share capital? It was 1 million, right? And what is the retained earning? Can anybody tell me the retained earning number? Can anybody tell me the retained earning number? It was 1,456,800. Thank you. 4,568,000. And then if I want to calculate 9 months profit, what is the per month profit? What is the per year profit? The per year profit was, I think, 165 something. How much was that? It was 165,056. Thank you. Whoever is helping. 165056 times 9 upon 12. What is the number? 165056 times 9 upon 12 is 123792. Okay. Next. Now fair value adjustment. As this data is from individual books, so you need to adjust the fair value adjustment land, which is 200K, 200,000. Now goodwill. What is the goodwill after impairment? Goodwill after impairment was, I think, 320,000 less 48,000. So it's 272K, right? Now, fair value of net assets of Starlight at 1st of January X6. What is the total number? What is the total? Please tell me what is the total, net total. 6163792. 6163792. Now you tell me how much this is the complete company. Okay, this is the valuation of complete company, and we have just given 10% of this company to the external parties. So simply if you multiply it by 10%, you will get the increase in NCI. You will get increase in NCI. Increase in NCI. This is the number of increase. It will be 616,379. Yes, 616,379. Just round it off. Okay. So this is your increase in NCI. And if you have taken classes, and even if you haven't taken classes, and if you have seen if you have read the basic materials, what entry you make now, giving you 30 seconds to check it, and then we'll make the entry. Okay. Now, how much cash we received? We sold 100,000 shares for £7 each, right? Sorry, $7 each. So 100,000 times $7 is 700,000. This is the entry. Debit bank 700,000. Now, as you can see that NCI is increasing, and whenever NCI increases, we credit it. So NCI will be credited by 616,379, and the remaining thing will go in other equity. It's 83621. Right? This is the entry. Now I need to ask one technical question. It's because I saw just one wrong comment. You all have to answer in this. Let's make it two-way traffic. Tell me, will this other equity will go in the OCI section with the income statement or not? Will this other equity will go in the OCI section or not? Correct answer. You guys are right. Yes, it will go in OCE, not OCI. Because in OCI we write those equity changes in which shareholders are not involved, and this equity change is with shareholders. This is the dealing of shares. So we are dealing with shareholders. So this equity change won't go in OCI, right? You can think that it will go directly in SOCI, statement of changes in equity. This will directly go in statement of changes in equity, statement of changes in equity. Now you can read this thing. See, the fair value of the consideration received is 700,000. Luna company should record a credit directly in equity. This thing. Okay. Is there any okay? Now, one more thing you can write extra points. See, it is not clear under IFRS 10 consolidated financial statement as to what happens to the non-controlling interest share of goodwill when there is a change in the relative ownership of subsidiary. IFRS 10 is silent regarding this issue. IFRS 10 is silent regarding this issue that do we have to change the fair value? Do we have to change the fair value? Do we have to change the fair value of NCI or not? And one more thing, see the last conclusion. These are extra points. If you even miss it, even in the examiner has written this. If you have missed these issues, the last issues, still you will get the marks. See, however, it seems reasonable that Luna company should reallocate 10% of the carrying amount of the goodwill to the non-controlling interest. This will ensure that future impairments of goodwill will reflect the revised ownership interest in the goodwill, right? Okay, this is the extra point. If you want to add this, you can add. Still, if you do this calculation and you explain it in a normal way, you will get good marks. Now we are moving towards the second area. Second area of this question, and that is related to IFRS 15. You know, this thing you better know that in SBR paper, question number 1 is not even 100%. Question number 1 is not even 100% consolidation. It's mixed with IFRS as well. They give you IFRS as well. They give you both things. Right? Okay. So let's move to the second area of this question. Now, giving you guys 2 to 3 minutes to read it. Just read it. And this paper is March-June 2022. Just read this and give your conclusion. I'm giving you 3 to 4 minutes. Read it and just think what is right according to you, what is correct according to you. Read this thing, please. Please read it and make your conclusion. Please, students. Somebody messaged me. Wait. Can you verify this? Can anybody add these all four again? This 6163792 is the correct number. Can anybody tell me? Or is there any calculation error? Student, who this thing, is this number correct? Can you please add it? Which retained earning is wrong? Is this 4568000 is the, wait. Oh, it's 4658. Yes. This is 4658. Students, transposition errors. When I asked you, somebody told me 4658. That's why I got a message that, sir, this number is wrong. So obviously this total is also wrong now. What is the total number? 6253792. And what will be the 10%? It will be 625,379. So accordingly, this will also change. Can you tell me what is the number of other equity? Take the difference, please. Take the difference and be active from now. That's why I told you to take the picture. Nobody told me. Can you take the difference between 700,000 and 625,379? 746. Okay, right? So be active with the numbers. Be active with the numbers, okay? You guys got it now? That's why it was not matching with this data. See, it was not matching with this data. Okay. On 20th March, X6. Okay, one student is asking what is OCE, what is the difference between OCE and OCI. I have written an article on it. I'll share with you guys, okay? Right? On 20th, yes, there is a question, sir. We have to explain yes, you have to explain everything in writing. In the requirement, it was written, explain, the word explain. So obviously it's about theoretical discussion, right? On 20th March X6, see this, Luna company sold 5,000 units to Starlight company at an initial transaction price of $200 per unit, $2, and control of the goods passed from Luna company to Starlight company on that date. See, control has been passed. So, you know, whenever, if you remember the stage 5, if you guys remember the stage 5 of IFRS 15, so whenever you need to book revenue point in time, so you have to check this control thing. And yes, the control has been passed. So it is correct to book the revenue. Payment is only due when Starlight company sells the goods on to the end user, which typically takes around 6 months. Okay, listen, you have given the control of parent company is Luna company, subsidiary company is Starlight company. Please, student, be very careful. Parent company is Luna company, subsidiary company is Starlight company. Parent company has sold goods, transferred the control to Starlight company, sorry. And now Starlight company will sell it further. To other guys and will pay later. So there is no issue with the payment terms. Control has been passed. Now, Starlight company had not yet sold any goods to the final consumer as at 31st March X6. That means complete URP. Complete URP. This is basic F7. Basic F7 level thing I'm telling you. Basic F7 level thing I'm telling you. This is complete unrealized profit URP. Hope you remember. So total profit will be URP. And in the consolidated books, you need to remove the URP. In the not individual books, in the consolidated books, you need to remove the URP. This is the first thing. Now, the goods have a high risk of obsolescence, and therefore price concessions are regularly granted in order that goods can be easily transferred or within the distribution channel. On the basis of past practice, Luna Company anticipates that it will, don't sleep, this is technical area, it will grant Starlight Company a price concession of between 8% and 38%. Current market data suggests that a maximum price concession of 35% may be necessary to enable Starlight Company to distribute the goods to the final consumer. Now, listen the deal. And you know, this deal I have seen in my country as well. I have seen this deal in my country, and the name of the entity is ICI. In Pakistan, there is a company ICI, and that company imports medicine from a company AstraZeneca. That means AstraZeneca, this is a practical example I am giving you. AstraZeneca gives medicine to ICI, and ICI sell it in the market. But there are some medicines which have short expiry date. So they have to sell quickly. So what AstraZeneca orders them to give discount. Okay, give discount, we'll compensate. They tell ICI to give discount and we'll compensate. This is the same case here. Okay, so that means Luna Company, the parent company has given permission to Starlight Company to give concessions, to give discount, so that the products are sold before being obsolete. See, there is a risk of obsolescence, there is a risk of outdatation, right? So parent company has given authority to subsidiary company to give concession, and yes, parent company will compensate. That means, now think, there is an element of variable revenue. There is an element of variable revenue. Student, be active. There is an element of variable revenue. Now parent company is not sure how much discount subsidiary company will give further. There is a possibility they will give 8%, 10%, 15%. Look at here, 20%, 25%. See, there is a range. Normally between 8 and 38%. 8 and 38%. This is the range. So now there is a topic of variable revenue. There is a topic of variable revenue, variable price here. So now there are two solutions. I'm giving you two solutions. The first solution. A normal, if you come to stage 3 of IFRS 15, you know, for variable revenue, you have to use statistical tools. For variable revenue, you have to use statistical tools. Let me recall you those tools. It is written on IFRS book as well. The first tool is EVA, expected value analysis, and one tool is most likely outcome. These two names you have also studied in IS 37. These two names, EVA, expected value analysis, and the second one is most likely outcome. EVA, expected value analysis, and the second one is most likely outcome. Okay, so first of all, you have to do the general discussion with the examiner that, see, they have company anticipate that it will grant a price concession between 8% and 38%. So now you can take a midpoint. Can anybody tell me what is the midpoint of 8 and 38? Can anybody tell me what is the midpoint of 8 and 38? Please tell me. The difference between 8 and 38 is 30. The difference between 8 and 38 is 30. And if you divide 30 by 2, it's 15. The difference between 8 and 38 is 30. And if you divide 30 by 2, it's 15. So now 8 plus 15. 8 plus 15 is 23. Okay. So now in your discussion, listen, in your discussion, you can write, that company can take a midpoint. Midpoint is basically the average. Midpoint is basically the average, right? So 23% is the midpoint. And what is the revenue? Can anybody tell me the revenue, total revenue? 5,000 units. 5,000 units are there, and 200 is the price. So 5,000 times $200, this will make, I think, 1 million. 1 million. Okay. So in the first instance, you will say that we can book revenue 1 million times 77%. Why? Because 23% we'll give them discount. 23% on average we can give discount. So we can book only 7,70,000 revenue. I'm repeating it. Listen. First of all, listen the story. This time we are not going to get the complete price from subsidiary because the product is very risky. There is a high chances that the product will be obsolete soon. So parent company has given authority to S company, okay, give discount, frequent discount, and we will compensate you the discount. That means subsidiary company won't pay the complete amount to parent company. So there is a discount range, but that discount is not fixed. That discount is not fixed. See this line. See this line, my dear students, please. This ranges between 8 and 38. Okay. So now we can take the midpoint as a common man. Even examiner has written, if somebody don't take the midpoint, he can take the 60% point. I have taken the 50%. Mid means 50% range. If somebody takes 60% or 70% range, still it is okay if you write your assumption. That's okay. So how did I calculate the midpoint? 8 and 38. 8, one end is 8, the other end is 38. The difference is 30. And if you do 30 divided by 2, you will get 15. So now 8 plus 15 is 23%. So 100% is the total amount. And if you deduct 23%, you will get 77%. So in our first explanation, we'll say that only 77% revenue we can book. Only 77% revenue we can book according to expectation. This is the first general explanation. Now the strict wordings of IFRS 15. I hope you remember IFRS 15 stage 3. Strict wordings of IFRS 15 for variable revenue. Hope you remember. Even in this audience, I have taught many students. You know, variable revenue. Look at here. Variable. Keep your ears active. Variable revenue can only be booked. Variable revenue can only be booked when reversal is impossible. When there is a high probability that we'll achieve, and there should be no possibility of reversal. And for this thing, now read the next line. For this strict thing, now read the next line. See, current market data suggests that a maximum price concession of 35% may be necessary to enable the trade company to distribute the goods to the final consumer. That means 35% is possible. 35% reversal is possible. So this 35% standard can't allow you. 35% discount is possible in this market. And that 35% discount means we, as a parent company, we won't be getting that 35% now. There is a chance there is a chance out of 100% we can lose 35%. So there is a chance. So when there is a chance, so you can't think of booking this 35%. So now if we talk about the pure rules, if you talk about the pure rules of IFRS 15, how much revenue can we book? Listen, this is the total revenue. This is the total revenue less 35%. And less 35% means 1 million less 35% means 3,50,000 out. So you can only book 650K. You can only book 650K revenue. This is the final thing. So what will be our final wordings that already parent company has booked the revenue for 1 million. Parent company has booked revenue of 1 million. Parent company has booked revenue of 1 million. So we need to reduce this revenue by 350,000 because of this variable revenue thing. And for variable revenue, IFRS 15 is very strict. For variable revenue, IFRS 15 is very strict that if there is a chance of reversal, they don't allow you. And yes, 35% discount is possible in this market. So you can't think of booking this 35% portion. You can only book 65%. So your final wordings for this question will be 650K revenue, not 1 million. They have booked 1 million revenue. So you will recommend them to please reduce the revenue by 350,000. To please reduce this revenue by 350,000, right? Okay. Now giving you 1 minute, giving you 1 minute. Yes, there is a question. Can we directly do 35% thing? Yes, you can do. 35% point is the strong point. The major point is 35%. But yes, as they have given you the range, so we need to just discuss this range. We just need to discuss 1 or 2 lines for this range. 650,000 is the final answer. Correct. 650,000 is the final answer. And now I tell you one thing. In this strategic level paper, they have asked you one thing regarding F3 level, F3 or F7, FA or FR level. Can anybody tell me what is the consolidation income statement treatment for P2S sale? This is P2S sale. What is the consolidation income statement treatment for P2S sale? Can anybody tell me? This is P2S sale. What is the consolidation basic treatment P2S sale? Yes, very good. The amount of transaction will be removed from consolidated sales as well as consolidated cost of sales. First of all, the amount of transaction, the amount of revenue will be removed from consolidated sales as well as consolidated cost of sales. Okay. And number 2, URP will be added. URP will be added in consolidated cost of sales. This is also the requirement of this question. This is also the requirement of the next question, I'll tell you, right? Okay. Now, whatever you have seen here, let me show you in the wordings now. And be confident, please. See this. See this, please. First of all, you have to discuss stage 5. And if you have seen the latest changes in the course, so you know, examiner has written openly, I'll share you that file, that now no need to write 5 stages name. No need, although these 5 stages are part of IFRS 15. Yes, they are heart of IFRS 15, but now no need to write the names of these 5 stages and no need to discuss 5 stages and state the rule. You should do direct application. That is the main focus of the examiner. Okay. Now listen, you know, revenue, the first thing of IFRS 15, even I made a vlog on this line. IFRS 15 stage 5 says that book revenue, IFRS 15 stage 5 says that book revenue when performance obligation is satisfied. Whenever the obligation is satisfied, whenever the deal is done, performance obligation is satisfied. Okay. So there are 2 options you have: over time. See this, over time you can book, or point in time. But as this is the case of goods, as this is the case of goods, and you just pass the control. So point in time is appropriate. So it's the correct treatment they have done. See, on 20th March X6, yes, the revenue should be booked immediately. This thing is perfect. The revenue should be booked immediately. This thing is perfect. But now the next thing. As per IFRS 15, price concession which is likely to be offered by Luna. In this case, the consideration is variable and uncertain. Yes, it's variable. Luna company should either choose an expected value method or most likely outcome. This I just told you. Okay, so our time is very precious. We can use expected value method because Luna has a history of offering price concession range from 8 to 38%. This seems to be more appropriate. If there is a limited information, Luna company can base its variable consideration by using midpoint C. This working I've done, right? So this is just the recommendation. This application 3 is the recommendation. Now, the real thing is this. The real thing is application number 4. Look at this thing, read it. IFRS 15 states that when estimating the amount of variable consideration, revenue must only be recognized to the extent that it is highly probable that a significant reversal of the cumulative revenue will not be required in the future. That means there is you should not do reversal in future. You should not do reversal in the future, right? Okay. And now finally I've written the end, and this is the conclusion. So I would recommend, in my previous webinars, I've also said to follow this approach: heading, sentence, heading, sentence, heading, sentence. See this. Yes, in the exam, it's better if you write in this pattern. And this is very simple thing. And I would say one more thing. You know, I'm giving the marking facility. I would say to send me the scripts in this manner. In this way, don't expect that on the last day you will perform like this. No, you have to start practicing just from today. Follow this pattern from today. Now, the easiest free marks of this question. Listen. Let me show you the requirement first. Sorry, where is the requirement? This is the requirement. See, right now we just did 6 marks. We just did this, discuss the principle that should be considered by Luna company. This requirement we just did. 6 marks. Now, requirement number A.3, using exhibit 1 and 2 only, present extracts that should be included in the consolidated statement of profit and loss. That means consolidated income statement. Actually, there are some students, they need break. If they need break, they can take. I'll give you the recording. This class is being recorded. Don't worry. There are some students, they need break, so they can take the break. I'll give you the recording afterwards. Okay. Now listen. Using exhibit 1 and 2 only, present extracts that should be included in the consolidated statement of profit or loss of the Luna Group for the year ended 31st March X6. Your answer should include the revenue. Number 1, consolidated revenue you have to write, consolidated cost of sales, and yes, the profit of Starlight attributable to NCI. You remember the last lines of income statement. You remember the last lines of consolidated income statement in which we break profit attributable to equity owners of P company and NCI. That NCI you have to calculate. That means you have to calculate NCI for income statement. You have to calculate NCI for income statement. Be confident. These 4 marks are scoring marks. These 4 marks are scoring marks. These 4 marks are scoring marks. Okay. Now, first of all, I would like to show you the question page so that you can take the pick if you want to take the pick. Otherwise, there is no need. See this. If you want to take the picture of this question, please, the question is in front of you. This part is in front of you, please. See, you have revenues and cost of sales for both companies. And yes, you have this. See this, all of you see this. You have profit as well. For the whole year, profit is also available. See, 165056 is the S company's profit. 165056 is the S company's profits. Now, let me solve it for you. Please. This is the requirement. This is the requirement. First of all, throughout the whole year, we had the control. Although, although the holding percentage changed from 80 to 70, but still for the whole year, first of all, best words. We always prepare income statement for the year. We always prepare income statement for the year. Okay. So throughout this for the year, we have the control. Okay. Although there is a change in holding percentage, but we had the control. So once we have the control throughout the year, so we'll do normal adding together. So first of all, you will add these two revenues. Now, what are the steps? What are the steps for P2S sale? What are the steps for P2S sale? Look at here. The amount of revenue will be deducted. The amount of revenue will be deducted from sales and cost of sales. Okay. So first method, they have already booked 1 million. See, in the question, you can see the question. They have already booked 1 million revenue, although it is wrong. In the last requirement, we rejected it. They have already booked 1 million revenue. So if you just follow them, what you do, listen, you will subtract 1 million from here and 1 million from here. This is also perfect. If you do like this thing, this is also perfect. There is one more solution. Look at here. You say, no. First, I want to correct. First, I want to correct the mistake. So that means they overstated the revenue by 350. Parent company overstated the revenue by 350. So from one side, there's a revenue 350 extra, and on the other side, the cost of sales is 350 extra. So first you will say 350K, right? First you corrected the mistake. Now you tell me what is the revenue left? 650,000. 650,000 correct revenue, which is still included. 650,000 is the correct revenue, which is still included. So you need to remove that as well. You need to remove that as well in the consolidated books. Okay. So again, it is the same thing. If somebody subtracts directly 1 million from sales and 1 million from cost of sale, that is also okay. And if somebody wants to show the breakup like 350, 650, 350, 650, that's also okay. So this is the first step. Yes, the first one is easy. Somebody just commented the first one is easy. Okay, you can follow the first one, 1 million directly. Now, what is the second step? Can anybody tell me? URP will be added in the consolidated cost of sales. URP will be added in consolidated cost of sales. Now you tell me how much original profit they booked. How much original? 200 was the sales price. And what is the cost? Can anybody tell me? 200 was the sales price. And what was the cost? Tell me, please. 80. So 200 minus 80. What is the profit per unit? 120. 120 is the profit per unit. And how many units were there? How many units were there? 5,000. 120 times 5,000. How much? 120 times 5,000. How much? 6,000. Okay. So you will add the URP. This is your URP. Okay. Now, please tell me this number as well as this number, please. Can anybody tell me the numbers? And please do the correct calculation for me. URP, how to calculate URP? It's very simple. See, cost was 80 and selling price was 200. So per unit profit was 120. Okay. And the units were 5,000. Okay. 5,000 units were there. So your URP is, this total profit is URP. Now tell me 42,997,700. 42, the revenue is 42,997. Okay, this is the revenue. And the cost of sales is, I think, cost of sales is how much? Tell me. 2879. Yes, 28796. 28796. 140. See, we have calculated the consolidated sales revenue as well as consolidated cost of sales. We have calculated the consolidated sales as well as the consolidated cost of sales. This working is separate. Okay. Somebody is asking a question, please. Why we add URP in cost of sales? Because we need to reduce the profit. When we increase the cost of sales, automatically our profit will go down. Okay. So URP is unrealized profit. Okay. Now the most interesting part, actually I teach all basic papers as well as advanced paper. I teach basic as well as advanced papers. Look at here. There is a question somebody is asking, that why did you calculate complete URP 600,000? Because originally the work already done by the examiner is this profit. They have already booked this profit. That's why I need to remove this profit. We haven't correct the individual statement right now. They have already booked this profit. That's why we need to remove this profit. Go and check. They have used this selling price and this cost. Now, since the beginning of your career, when you start the basic accounting, teacher says this thing many times in the class. And I say this again. Even I said this before in the same class. Income statement is always provided for the year. Income statement is always provided, we always make income statement for the year. But yes, we make SOFP as at. We always make income statement for the year, but we make SOFP as at. Okay. So now finally we need to calculate NCI. We need to calculate NCI for income statement. Okay. We need to calculate NCI for income statement. Sir, which NCI you are calculating? Hope you guys remember the format of consolidated income statement. Hope you guys remember the format of basic F7 level, not SBR level, basic. Whenever we do adding together in the income statement, in the end we write 3 lines. Whenever we do adding together in the income statement, in the end of the income statement, we used to write the 3 lines: profits attributable to equity owners of P company. And then the next line is NCI, profit attributable to NCI. So right now you have to calculate that NCI. So this NCI means NCI for income statement. NCI for income statement. And now students, look at the screen. This is your accounting period. This is your accounting period, which is April to March. And in this accounting period, first 9 months, our holding was 80, parent company holding was 80, and NCI holding was 20. parent company's holding was 80 and NCI holding was 20. But in the last 3 months, parent companies parent company's holding was 70 and NCI holding was 30%. Okay. So now we are working for the year. Okay. So for the first 9 months, we have to use 20% NCI rate. And for the last 3 months, we have to use 30% NCI rate. Can anybody tell me the profit? Of S company? What is the profit of S company? 165056. See this, 165056. First of all, multiply it by 9/12. This is first 9 months. And in the first 9 months, the NCI percentage is 20%. Now plus 165056 multiply by last 3 months means 3/12. And in the last 3 months, the holding percentage is 30%. Please tell me the answer. Please tell me the final answer for this NCI. $37137. Total answer, okay? Okay, this is the answer. Now, I have a very basic question because I'm sure you all forgot the basics. And I normally get the feedback from the interviewer because I recommend many students for job, and the next day the interviewer calls me. So you all forgot the basics. Why didn't we deduct URP from NCI? Why didn't we deduct URP from NCI? Come on, tell me. Why didn't we deduct URP from NCI? Very good. Thank you. Because it was P2S sale. Not S2P sale. Had it been a S2P sale, then yes, you would have to deduct URP from this as well, from URP from NCI as well. This was P2S sale, not S2P sale. Use your brain. Now I'm going to move for the third requirement that is also related to basic consolidation. Today is the day of basic consolidation, but with the latest past paper. Today is the day of basic consolidation with latest past paper. And you know, this happens many times. Sometimes students prepare top-notch advanced level and they ask basic things. I've seen many times. Even this happens. Sometimes students study non-stop IFRS 9 and in the exam they give you IS 38. This happens, very routine. Okay, so this is the point number 3. Point number 3 is related to joint venture, and I tell you this joint venture is just a name. In reality, they are asking about associates. That's it. Joint venture is just a name. You know, for joint venture we do equity accounting. Nothing related to joint control and blah blah blah. It's related to equity accounting, basic test of equity accounting, and then URP thing. Okay, now look at here. On first, Requite company provides information about the creation of Requite company, including details of a sale of property from Luna company to Rocket company. Now we are Luna company. We are the main heads. We are the main parent company. Okay. Now on 1st April X4, Luna company and an unconnected third party established a joint arrangement. In joint arrangement, you know, there should be a joint control. Okay. Involving the creation of joint venture. Hope you remember these two types of arrangement: joint operation and joint venture. Joint operation and joint venture. Here it is joint venture. Here it is joint venture, and with joint venture, we do equity accounting like associates one. Rocket company, each venturer has paid 6 million in cash. This is your COI. COI is 6 million. COI is how much? $6 million. COI is $6 million. Okay, right? Cost of investment. Hope you remember the meaning of cost of investment. To the newly created entry in exchange of 50% interest in the equity shares. Now, Rocket company has earned profits for the year of 73450 and 126980 in the year to 31st March X5 and X6. Now wait. The question is related to two accounting period. See this. 1st April X4 to 1st April X5. This is the first period, and this is the second period, students. Right? See, these are the two accounting periods, and you have the profits. The first period profit is 73450, and the second is 126980. Now, additionally, Rocket company is the joint venture, right? You can think it's your associate for easiness frequency. Rocket company is your associate, right? Company paid dividends to both Luna company and the other venturer, that means other investor, of 15,000 each. That means we received 15,000 dividend, and the other guy also received the 15, total 30,000 dividends. Now, do you guys know the treatment? Of dividends received from associate or not? It's a technical area of F7 level. Nowadays I teach this in F3 FA level as well. Dividends from associate, I teach in FA level, I teach in FR level, and I teach it in SBR level as well, and ICWA level as well. In all levels they are same now. Yes, the entry. Can anybody tell me the entry for dividend received from associate? Dividend received from associate, the entry is this. See, this is the entry. Bank debit and investment in associate credit. Bank debit and investment in associate credit. Bank debit and investment in associate credit. This is the entry. I'm sure majority of you don't know this, or you have forgot this, but this is the part of your course. Bank debit, investment in associate credit. Now let me tell you the logic. Sir, why didn't you book the income? You are receiving dividend from associates, sir. You are receiving dividend from associates, so you should book the entry bank debit and P&L credit. Bank debit and income credit. No, we have already booked this income. Because we book through profit after tax. We book complete profit after tax of associate in our income statement. So in profit after tax, already dividends are included. So we have already booked this dividend as an income, if you remember, right? So first of all, in this question, this is the, see this, all of you look at here. This is the first issue of this requirement. See, this is the first issue of this requirement. The second issue is separate. I'll discuss this separately. This first paragraph is the first issue. I personally want you to discuss this thing first and then the remaining thing afterwards. I personally want to discuss this first thing now and the remaining thing afterwards. Okay, wait. If you want to take the picture of the question, you may. If you want to take the picture of the question, you may. Okay, let me show you my working and then I'll show you the discussion. Wait. This is the requirement. See this requirement, B part. This B part. This is the requirement. Discuss with calculation with numbers How investment in rocket company and the sale of property. This is the separate part. The sale of property is the separate part. I didn't read it. I didn't read it even. Okay. This is a second part. Should be accounted for in the consolidated financial statement, not individual financial statement. It's about consolidated financial statement for Luna Group in the year ended 31st March X6. Okay. Right now, I am teaching you this part only this. See, I am teaching you this piece. Right now, I am teaching you only this piece. First piece. Okay, let me show you. See how you will do it. Read the remaining part afterwards. You know, as your joint venture is like associate, the accounting of joint venture is equity accounting, which is the associate accounting. Okay, so for associate accounting, you do equity accounting and you have to do one line adjustment. And what is that one line adjustment? You have to calculate carrying value of investment in associate, carrying value of investment in associate, or you can say, look at me, carrying value of investment in joint venture, carrying value of investment in joint venture, JV, right? I'm sure you all know this. First of all, we write COI. I have made things very easy. See, this is all a spoon feeding thing. First of all, we'll write COI, and the COI, I have already guided you 6 million. We have already checked that COI. We have already checked that cost of investment is 6 million. Now we add all the post reserves, all the post changes of net assets, or you call it post retain earning. So there were 2 years. There were 2 years in between. The first year, the profit of first year was 73,450, and the profit for second year was 126,980. Can anybody tell me the 50-50%? Because the holding was 50%. The holding was 50%. 73,450 times 50% is 36,725. Thank you. Okay. And then 126,980 times 50%, 63,490. Please don't do errors. We can't afford errors now. Okay. So COI, add post profits of associate company or joint venture. And now the last thing, we receive dividends. And for dividends, we make the entry debit bank. You told me debit bank, and credit investment in associate, investment in joint venture or investment in associate. This entry. Remember this entry. So we'll reduce dividend from JV. We'll reduce it by 15,000. Can anybody tell me the final amount? 6085215. Thank you. This will be reported as a non-current asset. This will be reported in the SOFP as a non-current assets, okay? There are other techniques. To calculate this carrying value of investment and associate, but this technique, I like this technique. Sir, why we take one question. Somebody asked a question. Why did we take 2 years profits? Because this working we are doing for SOFP. And SOFP is always as at. This working we are doing for SOFP, and SOFP is always as at. So we have to take the cumulative retain earning. We have to take the complete post retain earning, students. And they gave the data in the form of for the year profit. They gave you data in the form of for the year profit, Let me show you. In the question, I told this. See, this is your acquisition date, and this is your reporting date. Can you see? This is your first year profit after tax, and this is your second year profit after tax. So if you add these two, numbers, you will get the cumulative retained earning of the 2 years. If you add these two, you will get the cumulative retained earning. You will get the cumulative retained earning of all these two. Okay. And as you have to work for SOFP, so that's why we take cumulative thing, because SOFP is always as at. And I have followed the same method which you guys have been following for last FR level exams. Okay, there is other shortcuts as well which I didn't follow. Now read the discussion. Read the discussion of this part. Look at here. As per IS 20, Luna should adopt equity accounting basic thing within its consolidated financial statement for its investment. This means that in consolidated statement of financial position, the investment should be included as one figure within non-current. One figure means one line. One figure means one line adjustment. One line adjustment. One figure means one line adjustment. It will be recorded at cost initially, and it will be increased by 50% due to the increase in net assets. Increase in net assets means post reserves. Increase in net assets means post reserves. Okay. And normally these post reserves are post retained earnings. Normally these post reserves are post retained earning. Now, within the consolidated statement of profit or loss, you can 50% of the profit for the year. See, yes, in the income statement, obviously, I always agree, income statement is always for the year. Income statement is always for the year. So in the income statement, you will always include 1 year profit times your holding percentage. Okay. But again, as a single line, again in the one line, and you call it associate share of profit. Again, you write it in one single line and you call it associate share of profit. Since the profit is before deducting, see, this is the logic, payments during the year, it is important to exclude the 15,000 dividend received by Luna company from investment income within the consolidated profit or loss. Now wait. There is one concept. One thing is called individual income statement of P company. Look at here, this is technical point. One thing is called individual income statement of P company, and one thing is called consolidated. We make consolidated income statement by using the data of parent company's individual income statement, because we do adding together. And in the individual company, in the individual income statement, parent company books this all dividend income as a normal income. In the individual income statement of parent company books all dividend incomes from all sources as a normal investment income. So obviously this 15,000 parent company had already booked as an income. But now when we are doing consolidation, so in the consolidation, we are applying equity accounting for this. And in the equity accounting, we have taken this associate or joint ventures profit after tax. We have taken the joint ventures profit after tax for equity accounting. So dividends are already included. So dividends are already included in associate share of profit. So now we need to remove the investment income if that has already been booked by parent company. If that has already been booked by parent company, and hope you remember these treatment. In your FR paper, you used to do this. In your FR paper, because FR paper was pure number crunching paper. FR paper consolidation was pure number crunching. You used to remove it. Let me tell you the name. I think there was a question in your FR exam kit, VIAGEM, VIAGEM, and you used to do this treatment in your FR paper. if you remember or not. Now, calculation part. The share of profit of the joint venture for the year ended 31st March X6 should be calculated as see this working, and this is the dividend. Now, you know, they have netted off these things. See this thing. This is the second working. First year profit, second year profit, and less the dividends here, complete dividend here, and then multiply it by 50%. Then multiply it by 50%, you will get the same answer which I got. All of you, let's try. See, if you netted off these three things, if you remove the dividends from here, total dividends from here, you will get 170, you will get 170,430. And when you multiply 50% on this 170,430 and add it in 6 million, you will get the same number. See this thing. You can better understand. See this thing and this thing. This is the shortcut. This is the shortcut, but look at here. All workings in front of you. All workings in front of you, student. Please take your time. All workings are in front of you. You can take your time. Please have a look. Please have a look. Take your time. I'm giving you time so that you can settle your mind. Yes, one guy is asking, so subsidiaries dividends are also cancelled. You are correct. Now, before we move on to the remaining requirement, let me teach you something. Now I'll teach you a new concept. For many of you, this will be a new concept. Look at here. Look at here. I won't move forward now. First, I will teach you something new, and you will understand. I'll teach you with logic. Many of you now, don't sleep. I'm going to give you break just after 15 minutes. After 15 minutes, I'll give you break. I won't teach you the complete question in one go. We'll teach in pieces, but this is the last topic before break. This is just for your motivation. Listen, we all have studied unrealized profit. Yes, since beginning. Have you ever think about unrealized loss? Have you ever think about unrealized loss? Unrealized loss. Did you ever think about unrealized loss? Yes, this is also a concept. This is also a concept, and it has been tested once in your P2, old P2 paper. The name of the question was merchant. The name of the question was merchant. If you remember or not, merchant. If you see the original full question of merchant, they asked the concept of unrealized loss. I'm not sure all of you know this or not, but I will teach you right now from the basic. It will take five minutes. Listen, for example, parent company bought the inventory for 1,000. See, parent company bought the inventory for 1,000, and the fair value of this inventory, the real value of this inventory is 1,500. But parent company intentionally sold this inventory to S company for 800. Okay, 800. Now there is a loss of 200. There is a loss of 200. There is a loss of 200. I have a question. Do we need to adjust this loss? Do we need to adjust this loss? Yes, we need to adjust this unrealized loss. And you remember what was the double entry? What was the double entry? What was the double entry for unrealized profit? The double entry for unrealized profit was this: CR debit 200 and inventory credit 200. when you guys used to study unrealized profit, URP, please, energy. When you guys used to study URP, you used to make this entry. Now this is URL, unrealized loss. So you need to make the opposite entry, and the opposite entry will be inventory debit, wait, and CR credit. Now wait. Let me post this entry, inventory debit. So now you will add 200 in the year-end inventory. You will add 200 in the year-end inventory. So it will become 1000. It will become 1000. And believe me, this 1000 is the perfect number. This 1000 is the perfect number. Why? Because IS2 says inventory should be recorded at lower of cost or NRV. IAS2 says inventory should be recorded at lower of cost or NRV. Look at here. This is we are working for group accounts. For the group point of view, see, the goods are entering in the group for 1000. This is the cost, and this is the NRV. This 1500 is the NRV. Cost is 1000 for the purpose of group. See this packet for the purpose of group. What is the original cost? 1000. And what is the NRV? The fair value is 1500. So the lower number is 1000. So 1000 is the perfect number to be recorded. So yes, it is 1000. We can't afford to record it at 800. There is no IS2 like this. We have to record it at inventory should be recorded at lower of cost or NRV. Lower of cost or NRV, and see the cost is 1000 and NRV in this case is 1500. NRV is 1500, so lower is 1000 and 1000 is the perfect number. So yes, in this case, the case which I just taught you, we have to make adjustment for unrealized loss. Yes, this entry is badly needed. I hope you understood this concept. This was the first concept. The second concept is left. The second concept is left. Wait. I'm giving you the second concept as well. And this revision was needed. Yes, I taught you in my normal class. Some students are saying, yes, I teach this in normal class. I remember, but still the concept is technical. Now let me tell you the second case. Now we bought the inventory for 1000, and suddenly, because of obsolescence or technology change, the fair value of inventory came down to 800. The real fair value is now down. In reality, the value is down. And now we sold it for 800, the same fair value. Okay. So at the year end, the inventory is at 800. Now, in this case, when the fair value is genuinely down, this is the genuine, no need to do anything. Very good. One student just commented. Now no need to do anything. This 800 is perfect. Why? Because again, IS2, inventory should be recorded at lower of cost or NRV. See, now the cost is 1000 and NRV is 800. Cost is 1000, NRV is 800. So yes, this 800 is perfect, and the inventory is already at 800. Inventory is already at 800, so it is perfect. So it is the best. Okay, so what is the summary? Sorry for your time, taking your time. What is the summary? That if the fair value is genuinely down and you are selling at fair value, so now you don't need to do any adjustment, because this is real impairment now. Now this is a real loss, and from the group point of view, it is also a loss. Got it? Now, I expect that you know the URP rules for P2A, when parent company sold goods to associate and associate sold goods to P company. This is also a topic. Listen. Listen, for example, we have a carrying value of a non-current asset. Just take the example of carrying value of non-current asset is 1,000. The carrying value of non-current asset is 1,000, and we sold it for 600 to our joint venture. We are parent company, and this is our JV. This is our JV, 50% holding. JV is again associate, please, simple. JV is associate. So carrying value of our land is 1,000 and we sold it for 600. We sold it for 600, right? So, but the fair value was 1,200. Now what you expect? What you expect? Is this a genuine fall or artificial? Carrying value is 1,000. We sold it for 600, but the real fair value was 1,200. So this is artificial. So in this case, we need to adjust the unrealized loss. In this case, we need to adjust the unrealized loss. This is the case number one, because this is artificial. This is not genuine. This is not genuine. You are not getting. Are you getting my point? Because I taught you from the basics of subsidiary rules. My dear, beautiful students, respectable students, this is like the case number one, when the carrying value is 1,000, but we sold it for 600, but the real fair value is 1,200. So this is artificial loss. So yes, you need to adjust here. But what if my students, look at here, carrying value is 1,000, sold for 600, and fair value is also 600. Now what will you do? Now what will you do? Now this is going to be a genuine loss, and now you don't need to do anything for unrealized loss. You don't need to do anything for unrealized loss, although you are 50% of this joint venture. And you know, I'm sure you know the rules between the subsidiary and associate. You better know the rules for subsidiary and associate unrealized profit. Whenever you are dealing with a subsidiary, you have to adjust complete URP. Whenever you are dealing with a subsidiary, you have to adjust complete URP or URL. But whenever you are dealing with associate, first you multiply URP with 50% or your holding percentage, right? Remember the rules? So this is the genuine loss. This is a genuine impairment. This is a genuine loss. This is the genuine impairment. So you don't need to do anything. Just simply book this real loss. See how you will make the entry. Sold for 600, bank debit 600. Okay, you carrying value of land is 1,000. You will de-recognize your land by 1,000, and you will simply book this 400 in your P&L. This is a genuine loss. This is a genuine loss. Now you don't need to do any adjustment of unrealized loss or unrealized profit, although there is no unrealized profit. But if it would be an unrealized profit, normally we do adjustment. But now we don't need to do any adjustment for unrealized loss because this is genuine loss. See, the fair value is also 600. This is genuine impairment. The loss should be booked now. My dear student, did you understand my point of view or not? All of you, please comment. All of you, please comment. Did you understand my point of view? Other students, please comment, please. And now this question is a piece of cake, the remaining part, because I've taught you. Just read it. Read the question. See this. Student, read this part. Please read this part. On 31st March X6, Luna company transferred. Luna is parent. On 31st March X6, Luna company transferred. Luna means parent company. Luna means parent company. Transferred a property to Rocket Company for proceeds of $8 million, which is agreed to be equal to the market value of the property on that date. On that date. See, we sold it for 8 million and 8 million is the genuine market value. The carrying amount of the property in the financial statement was 10 million. See, I taught you just right. I just taught you the same thing with 6 million, same thing. So do you think this is a genuine loss? Yes, this is a genuine loss. The carrying value was 8 million and the fair value was 8 million and the proceed is also 8 million. So you will simply de-recognize your land. You will simply de-recognize your property and you will book this genuine loss in the P&L. No need to do any adjustment for unrealized loss, please. No need to do. I have taught you the everything right now. Okay, read it. And then I'm giving you a break. Just 1 minute, please. First of all, see this part. No, sorry. Yes, this part. IS 28 does not require the gain and losses arising between the parent entity and its joint venture should only be recognized to the extent of the unrelated investor's interest in the joint venture, right? If this was genuine URP, then definitely you have to adjust because the 50% part is, we are the 50% part. The half body of that joint venture is us. So definitely unrealized transactions should be adjusted up to the extent of our holding percentage. Unrealized profits and unrealized losses should be adjusted up to the extent of your holding percentage. This we have studied in associate as well. This is relevant to Luna company as they have sold the property to Rocket company, a downstream. P2A is downstream at a loss of 2 million. See, since it is agreed that the proceed of 8 million are equal to the market value, so it's a genuine loss. This provides the evidence of that the property was indeed impaired. Yes, it's a genuine loss. So now you can book it. Luna company should recognize the loss of 2 million within individual and consolidated financial statement. If you want to make the double entry, the double entry will be bank debit 8, P&L debit 2, and property credit 10. You will de-recognize your property by 10. You will debit your P&L 2 and 8 debit bank. Okay. First of all, tell me, did you understand this part? All of you, please say, did you understand this part or not? Okay, let's take a 10 minutes break. Let's take a 10 minutes break and then we'll join again. Okay, 10 to 11 minutes break. Welcome back. Now the last requirement of this question, and this part has tested, the examiner tested this part, this same thing many times, and yes, again in this question now. And you know, this is the area in which there is a change as well in 2018. IFRS, there was a current issue related IFRS 3, and now that current issue is the past part of course. Now that current issue is the part of course. Let me give you a slight introduction of this before we move on. See this. This is parent company and this is S company. You know, whenever one company acquires another company, we apply IFRS 3. The name of IFRS 3 is business combination. The name of IFRS 3 is business combination. The name of IFRS 3 is business combination. Business combination. So you can only apply IFRS 3 if you have acquired a business. You can only apply IFRS 3 accounting if you have acquired a running business. Okay. If this subsidiary company does not meet the definition of business, then this should be treated as the acquisition of single asset. In the history, past papers, there was a very old question of 2008, Celtec, SELTEC, Celtec. In that, P company acquired a business, and that business had only 2 shops, 2 retail outlets. And the objective of that takeover is to buy those shops. There was no operations with that company, no employees, nothing. So in that question, in the end, we concluded that we haven't acquired the business. We just acquired those 2 shops. And now you can either apply IS 16 or IS 40 if you are earning rental income from those shops. So now in that question, you can't apply IFRS 3. So you can only apply IFRS 3 when you have acquired the running business. You can only apply IFRS 3 on subsidiary when you have acquired the running business. And for running business, hope you remember that nothing new I am teaching. Yes, very good. And for business, there must be 3 conditions: input, process, and output. Input, there must be some input, there should be some process, and there should be some output. Okay, so now we need to check it out, and things are very comparatively, this is easy part. Okay, let's start. ACCA company provides, okay. ACCA company is an entity which has a sole purpose of producing a new medicine. This company is producing a new medicine to fight various diseases, having secured a license. Yes, they have a license to do so the following successful initial trials, and the trials are going on. So the trials are itself is a process. The trials are going on, that means they have employees, they have a procedure, they do experiments. So there is a process I can see. And this license itself is a basic input. Be active. We have to gather evidences. ACCA company's employees consist of highly skilled team of scientists. See, they have the team of scientists. There is also a small support team under contract who carry out various administrative and accounting functions. See, the functions are going on, so there is a process. Clinical tests undertaken by the team of scientists have been extremely encouraging. They are going excellent, and it is expected that the medicine will be on the market sometime within the next years. See, the medicine will be in the market. So when this medicine will go in the market, it will generate profits for the owners. So that means there is output as well. There is an output of this whole function as well. So we have, in this first paragraph, we have identified the 3 basic things. Input itself is a license itself is the input. There are initial trials, clinical trials, successful trials. they have employees, they have accounting function, administrative function. So there is a process. So there is a process, my dear students. Two things. And the third thing, third thing is output. This whole setup is going to produce a medicine which is most likely in the next year it will be in market. When it will be in market, it will generate profits, dividends, returns for the owners. Okay, so yes, the basic IFRS 3, the old basic IFRS 3, which have been continued for years and still applicable, the three conditions have been met. So looks like it's a business. Okay, now next para. On 31st March X6, Luna company acquired 100% of Eclipse company. It was also decided that it would be important to retain the contracts of the team of scientists, although not the administrative employees. See, we can't lose the scientists. We can't lose the scientists, as there was considered specialized knowledge and experience within the team. The only, now they are distracting your focus. The only, see the word, the only asset recognized in the individual financial statement of Eclipse company at 31st March X6 consisted of the license. See, they are saying that there is only one license. There is only one license to manufacture the medicine and related development costs. However, Luna company estimates that it was worth paying an extra 1.5 million in consideration in order to secure the skills and experience of the team of scientists. Now, in total, there are three issues we have to discuss in this. I'm telling you right now, and I'm making your mind right now. I'm making your mind right now so that you can go very smooth with this question. The first issue, which is in the first paragraph, according to our old IFRS 3, according to our old IFRS 3, you can only apply IFRS 3 if that acquisition constitutes the definition of business. And for business, you must have three things: inputs, process, and output. In the first paragraph, I have proved all these three things. So according to old IFRS 3, yes, it's a business, so IFRS 3 can be applied. Now, since last 4 years, there is a new test. There is a new change in IFRS 3, and that is called, I think, concentration test. Optional. Listen the word. There is an optional, not mandatory, optional concentration test through which you can see that this is a business or a single asset. Listen. For example, you are buying a business, so obviously you will pay a price. You are buying a business, and obviously you will pay the price for it. Let me explain you with the help of a drawing. This is the complete business. This rectangle is the complete business, and there is one asset. See, this in between there is oval. This oval is one of the asset. So you are going to acquire this complete rectangle. You are going to acquire this complete rectangle. And what is the concentration test? If you are paying majority payment for this asset, if you are paying majority payment, for example, 90% payment you are paying for this asset, all the fair values to all the payments which you are paying to acquire this complete setup is related to this asset. 90%, 95%, 90%, 95% payment is related to this asset. So that means your intention is to buy this asset, not the whole business. Your intention is to buy this middle oval, not the whole business. So in that case, you will apply IAS 16. You will treat it as an acquisition of asset. You will treat this setup as an acquisition of asset. Okay, you got it, the concentration test. Now let's apply the concentration test on the second paragraph. Now let's apply the concentration test on the second paragraph. In the second paragraph, apparently, it looks like They have used the word the only asset. See this word. See this word. They have just to distract you, just to distract your focus. They have used the word the only asset in the financial statement is the license. So looks like that we are buying only license, but this is not the case. This is not the case. See the last line. See the last two lines. See the last two lines. However, Luna company estimate that it was worth paying an extra $1.5 million. It's a significant amount. It's a material amount in consideration in order to secure the skills and experience of the team of scientists. That means you are not just buying the license. You are not just buying the single asset. You are buying this complete setup. You are buying this complete setup, and you are paying for different things. You are paying for different things. You are not just paying for license. You are paying for different things. So we can say, even with the concentration test, even with the application of concentration test, yes, it is a business. We are acquiring a business. Yes, we are acquiring a business. Did you get my point? These are the two major issues of this question I have solved. Two major issues of this question I have solved. Now the third thing. Now the third thing is about practical consolidation. Now the third issue is about practical consolidation. I'll tell you, wait. Listen, this is about fair value adjustment. Fair value adjustment. Let me teach you in this style. You will understand. For example, I have acquired this complete business for $100. I have acquired this complete business for $100. Okay. Now I need to calculate the goodwill. Definitely, when we buy running business, we have to calculate goodwill. So with this business has a building of $20, cars of $20, and inventory of $10. Okay, so you are paying $100 for the whole business, and the business has 3 separately identifiable assets. So automatically you are paying goodwill. You are paying goodwill of 50. Automatically you are paying goodwill of 50. You know this. You know this. I have taught. Now I'm teaching with using very basic technique. $100 for the complete business, and there are 3 separately identifiable asset: building, car, and inventory. So automatically the remaining residue is your goodwill. Okay. Now, you know the meaning of fair value adjustment. For example, I have just calculated this goodwill 50, but suddenly my accountant came and he said, "Sir, there is a mistake. Sir, there is a mistake. Sir, there is a mistake. Look at here." Wait, let me wait. I have to reconnect my iPad. Just 1 minute. Sorry. Just a minute. I have to reconnect my iPads. Okay, it's fine now. It's fine now. So we paid $100. We paid $100 for the whole business, and the goodwill is 50. Now I just calculated this goodwill. Suddenly my accountant came. Look at me, please. Suddenly my accountant came and he said, "Sir, there is a mistake. There is a mistake." I said, "What?" "The fair value of this building is not 20, it's 25. The fair value of this building is not 20, it's 25. So I just added 5. I just added 5 in the building. So automatically now the goodwill will be, now the goodwill is 45. Now automatically the goodwill is 45 because now we did fair value adjustment. Similarly, the way I'm teaching you fair value adjustment, similarly, sometimes we have, look at me, sometimes we have to recognize some intangible assets. Means subsidiary company did not recognize some intangible asset previously, but we should recognize it as a part of group. For example, internally generated brands. For subsidiary company, internally generated brand, they can't book internally generated brands. Subsidiary company cannot book internally generated brands in its individual books. But for the group purpose, from the parent company perspective, it is a purchase brand. So yes, parent company can record separate intangible assets now. So what we do, let us say we are recording one new intangible asset here. Intangible asset of $10 here. So now when we record a separate intangible asset here, our goodwill will be 35. Our goodwill will be 35. So this is basic accounting which I'm teaching you, that we do at the date of takeover. At the date of takeover, not only we do fair value adjustment, but also parent company recognize or give birth to certain intangible assets of S company. But you know, in order to recognize these intangible assets, we have to open our eyes and we have to check some criteria. Hope you remember IS 38. Intangible asset must be identifiable. Intangible asset must be identifiable or separable. Intangible asset. Hope you remember the basic first line of IS 38. Intangible asset must be identifiable or separable. That means they can be transferred, they can be rented. Okay. So if there is an intangible asset which cannot be transferable, if there is an intangible asset like there are knowledge or something, employees which are not in our control. So if there is something like skills or something which are not transferable or not separable with the business, so then you cannot book this. Then you cannot record that as a separate intangible asset. Then in that case, you cannot record it as a separate intangible asset. And in that case, those intangible assets will be the part of goodwill. Those intangible assets will be assumed to be the part of the goodwill. They will stay inside the goodwill. They will stay inside the goodwill. I hope you remember this. I hope you got my point. What I'm telling you, the third issue. Did you understand this third issue of intangible asset? That whether you can recognize the intangible asset or not. Okay, so these are the three issues in this question which you have to discuss. These are the three issues in this question which you have to discuss. The first issue is about input, processes, and output. I've told you. The second issue is about the concentration test, which I've already told you. And the third issue is about the recognition of some separate intangible asset. Recognition of certain intangible assets like skills of workforce or like the employees and all. So we have to answer the third part, that can we record these employees as a separate intangible asset or not? So these are the three issues. Let's move to the requirement. But before we move on, if anybody of you want to take the picture, I have already forwarded the question paper on your WhatsApp group. Already forwarded the question on your WhatsApp group. You can see. Now let's see the requirement. First thing, discuss whether the acquisition of ACCA company should be treated as a business combination in accordance with IFRS 3 business combination, right? So in this 1.5 line, both things are included. In this 1.5 line, old IFRS 3 as well as the concentration test is included. Now, your answer should consider, see one more thing, your answer should consider whether the skills and experience of the team of scientists can be recognized as a separate identifiable asset or not. Skills and experience of team of scientists. The basic answer for last thing is no, because these skills, these employees are not separable. These are not separable. They are not transferable even In some cases, look at here, your employees are not in your control. Your employees can go anytime. Your employees can resign anytime. So that's why we don't book the employees as an intangible asset. Yes, sometimes, wait, sometimes we have some special contracts with the employees like football players, and we have enforceable contract that they can't go. Then that's the separate case. But such thing is not written in the question. Such thing is not written in the question. Okay. One more thing. Yes, like military. Very good. One more thing. In order to generate these skills, listen very carefully. In order to generate these skills, as you have seen, this is the medicine research based business. Lot of cost are research cost. And research cost goes directly in P&L. Research cost goes directly in P&L. Yes, development cost can be capitalized, but normally with such businesses there is a lot of research work. So that's why research cost goes directly in the P&L. So on the basis of these 3-4 arguments which I have just given you, you cannot book it as a separate identifiable intangible asset. So this is the true answer of these 3 issues. Let's move to the solution part, and you can see how can you write it. Look at here. This is the first area. For the acquisitions to be treated as a business combination, it is necessary to assess whether the activities of a company constituted a business in the first place. Very simple dialogue. Whether it is a business or not. If it is a business, yes, IFRS 3. If not business, no more IFRS 3. This means that activities must have been capable of being conducted and managed in a way for the purpose of providing a return to investors or other owners and members. This is the basic definition of business. You have seen in other past papers as well as in your exam kit. Now, this is the application. The components of a business will consist of input and processes which have been ability to create outputs. Inputs are economic, they are defining inputs, okay? Process will involve strategic management, operational, capable of being to create. What are the process in this case? In this case, inputs in this question was license. What was the process in this case? Tell me, what was the process? Clinical trials was the process, okay? And in Eclipse case, inputs are in place having secured license, license to manufacture. Operational and management processes would be associated with the performance and supervision of the clinical trial. This is the process. And the output was the product itself, which is going to be in the market next year. The output will be the product itself, which is going to be in the market next year. Now, here I have written the concentration test in my own words. See, Luna company may apply a concentration test. This is optional test, okay? In which it needs to be checked whether the price paid to acquire the business is concentrated in a single asset. If you are paying the price, remember the oval. If you are paying the price for the single asset, if this is the case, then don't treat the acquisition as acquisition of business. In that case, it will be treated as a separate asset acquisition. Okay, this is the rule. I'll write the final answer in the conclusion. The conclusion is left. The conclusion is still left. Okay. Now, this is related to IS 38. They have asked you that whether the remaining, the workforce, the skills of the workforce and the scientists can be recorded as a separate asset or not. See, read it. As per IS 38, it would not be permitted to recognize the knowledge and skills of the workforce as a separate intangible asset within the consolidated financial statement. Why? See the reason. The workforce is not separable and it cannot be sold, transferred, rented, or otherwise exchanged without causing disruption to the acquired business. Otherwise, the business will be down. Okay. Hence, this should be subsumed into the goodwill. Remember my rectangle. When you cannot recognize an intangible asset separately, then that intangible asset becomes part of the goodwill. Then that intangible asset becomes part of the goodwill. I already taught you that rectangle. The workforce represent intellectual capital of the skilled workforce, which is the specialized skills and experience that employees bring to their jobs. That's correct. In relation to a clip company, it is likely that much of the process and systems which have been undertaken to the development have been documented. Yes, there is a possibility that they have documented everything. It's a formal company. So yes, already things are documented, but still the major portion are the skills of the employees, right? Some of these costs have been capitalized as development costs when much of the knowledge was obtained during the research phase. See, I've already told you that research cost cannot be capitalized, and in such businesses, the way they have presented us, major cost looks like research cost. That's why it cannot be capitalized. That's why, wait a minute again. So see, since this is the conclusion, and this conclusion is based on the basis of that test, concentration test. See, since Luna company acquires not just the manufacturing rights, not just the license, but the assembled workforce. Remember the $1.5 million. Remember, we paid $1.5 million for the workforce. It is unlikely that the concentration test would be met. The acquisition should be treated as a business combination. So that means we just not acquired a single asset. We acquired the complete business. Okay, right? So now, dear student, this was the discussion on question number 1. It's okay. Actually, I teach for teaching purpose. That's why it takes a lot of time. But in the exam, when you practice, in your studies, when you practice, you can go fast. One thing I would like to say very openly: since last 2 years, I have seen many students. After the exam, they give feedback that we knew the paper, we knew the 100 marks, but we couldn't complete more than 80 marks. We could manage only 85 marks. This is the issue nowadays. It's going on last 2 years. I have seen, because I teach a lot of students and I'm in touch with many students. So the only solution of this is the mock exam and past paper practice with timer. Please, with stopwatch. Please start working using stopwatch, that you have to complete things in a certain period of time. If you give 1.5 hours on question number 1, then obviously you won't be able to do question number 4. This is very basic maths. So yes, it's a professional paper and you have to understand this challenge. Why? And now one more question. Why examiner makes such paper that it's very difficult to complete? Because in the real life, you have to act fast. In the real life, your employer also give you deadline, and in the real life, they also give you tough time. In the audit, if you go to audit field, there are deadlines. You have to complete things within certain period of time. You have to give overtime. So that's why they are preparing you for real things. You can see the question. These all are real life issues. If you see the remaining questions of this past paper, they all are real life issues, real things. Remember, in this question, when we were discussing IFRS 15 part, I gave you the real example of ICI. And this example, this has been doing with ICI last 10-15 years. 10-15 years. One of the manager of ICI told me that this is the setup of that company. So this is, they are preparing you, they are preparing you, dear student, for real life. So there is a time management issue, and still you have many days. Still you have this last month. Please do written practice. Send us the scripts. We'll mark your scripts. Try to do things in written form. Okay. And I'll update you the next class, next webinar timings on the on your WhatsApp group. Not next 2 days. I won't be conducting in next 2 days, but I'll tell you the time of the next class. Okay. Take care and Allah Hafiz. Bye bye.